Well, for more on today's trade, Chris Conway from the Australian Stock Report joins us live in the studio this morning, plus Noel Yates live from Macquarie Private Wealth in Sydney as well. Good morning to you both. Chris, we'll kick it off with you in the studio. Not a great start to today, and unfortunately we couldn't hold on to yesterday's gains. What do you make of sentiment in the market at the moment?
Oh, look, it's completely shot at the moment. I was expecting a bit of a further bounce today, or indeed overnight in the US, following from the better than expected trade data from China yesterday. The PBOC, as you said, have reset the yuan rate for the past 3 sessions at a similar sort of rate, and we were starting to see some signs of life, really, but snuffed out overnight. Oil prices have been the big problem, and yeah, I think sentiment is really shot, and the big worry now is that we let go of 4,900 on the ASX 200. I said last week on the cross that was the sort of the line in the sand. We have dipped below there today. I think we got to 48.70. Yep. If we don't hold on to that and we see a sharp technical break, I think that's when long-term investors really need to start making some pretty hardcore decisions about their holdings.
You think the circuit breaker for this falling crude price is what? Even a wipeout so that we get almost flatlining on prices? Is that foreseeable? Is that possible?
I think it is. I think it is. It's certainly a race to the bottom at the moment. A lot of production is going to have to be shelved. Only once we start seeing that, a whole lot of oil companies going to the wall, do I think that we get any sort of semblance of balance in that supply and demand equation. It's so out of whack at the moment. It's been out of whack for quite a long time, but you know, it will probably go.
And is it going to be kind of a Dick Smith style? The bank is running out of patience, therefore triggering the inevitable. What brings us to that point?
Yeah, one would think so. Those companies that are carrying a lot of debt, simply, you know, the banks and the finances that are supporting those companies, they'll just say, well, we're not interested anymore because we don't see oil prices turning higher.
Noel Yates, let's bring Noel Yates in from Macquarie Private Wealth. Noel, good to have your company on the show. Look, we're down 1.6%. Nikkei down 3% now, so extending that loss quite significantly. Look, what's your take on this? What's driving the losses around the globe at the moment, in your view?
Our view is that this is probably somewhat of an adjustment post-Federal Reserve interest rate announcement in December. We've got economies where people really don't know which direction they're headed. Safe haven, of course, is cash and bonds. And what we're seeing in the US particularly is this nervousness about, is the US really growing as strongly as everybody thinks? Can it withstand it? What happens if we're wrong? All of this sort of stuff. We see this as a fairly dramatic January, but we don't see this as the whole story for 2016 by a long shot. In fact, we're rather more optimistic toward the end of the year because we actually think US growth is pretty good. What the interesting point here will be is what happens if US growth is actually pretty good and you're sitting in cash, you're going to have a pretty ordinary year.
No, it does seem hard, though, for the Fed. I mean, we know the Fed held off on hiking rates originally because of what was going on in China. It does seem like it will be more difficult for the Fed to hike rates and continue on that cycle that it's shown its dot plot when you do have the global economy acting how it is, or the global markets, I should say.
And we don't think they will, and that's the point. We think they were probably sending a signal that they've stopped the easing process. That doesn't mean they've actually started a tightening process either. What I think we're seeing here is investors somewhat confused about which direction to move in. One of the really interesting things here is we've got such cheap energy prices. Now, cheap energy prices for the US should actually be a bumper for the economy, should actually knock it out of the park. That's what the fundamentals will tell you, that's what every history book tells you. But we're not seeing that yet, so we've got this delayed reaction in the US economy. Once we see that, I think then what you'll see is some fairly good growth. But at the moment we're in this point of will we, won't we, will we, won't we? And that's, I think, markets hate anything. There's one thing markets hate, it's uncertainty, and that's what you've got at the moment. You've got this uncertainty about growth. Hence we think the China story is somewhat a bit of a side play. The real play here is the US, and that's really what is driving all of the action, all of the activity. Everybody's responding to it, not the other way around.
So without getting too micro on it, but with that,
please do cast
average wages then as a component of the job story in the US, they're not exactly shooting the lights out to imply demand, aggregate demand is where it should be to justify the company capex spend in the real economy. It's absent. It's a key part of the puzzle that's absent. It's confounded Janet Yellen. It's annoyed her. Yeah. It's dismayed her, in fact.
And what you've got is a whole process that occurs here, and in our 24/7 cycle we're expecting this to happen very quickly. Economies take time to adjust. Data takes even longer to read. So what you're seeing here is you've got this pickup in employment in the US of a very, very low low base. What we haven't yet seen, as you correctly point out, that lift into aggregate wages. Once that lifts into average wage rates, then what you'll see is increased spending in the economy. Once you see increased spending, you see increased growth. That in normal terms, Carson, would take a 2.5 to 3 year cycle. What we're all expecting is we want to see that in 2 to 3 weeks.
I just wonder whether it is possible even in the cycle you flagged, because Chris, the productivity gains that have come off the back of this in the United States mean that you cannot justify paying the increases, because you have automated, you have done so much to supply chains that you really don't need to be bonusing people out of the park when so much is now being outsourced to those types of improved areas of the business.
Yeah, certainly there's been a structural shift in terms of the type of employment in the US economy. Yep. It's McDonald's and service jobs like that, lower paying, part-time jobs. So there's been good jobs numbers, but is it really reflective of what's happening on Main Street? And some have suggested, and probably rightly so, that it's not, hence why we're not seeing the wage growth. I completely agree with Noel, though, that lower oil prices will eventually flow through to the US economy and be a boon. So wage growth might remain stagnant, but consumers ultimately will have more money in their pockets to spend eventually, and that has to feed into the US economy. And of course, 70% of the US economy is made up of the US consumer. So 12 to probably 18 months.
Okay, I want to move on from the macro story and move into some of the stocks we're watching today, Chris, because Wesfarmers is certainly the big story of the day. When it comes to acquisitions, looking at Homebase, of course, in the UK. Now, you've been saying, Homebase has pretty poor margins at the moment. Do you think Wesfarmers is the knight that can turn it around?
There's so many horror stories of Australian companies trying to go offshore and completely ruining it. The numbers seem to stack up. 1.5 billion revenue, only 26 million pounds in revenue. So potentially they have the ability to turn that business around, make it more efficient, increase some margins. But they're operating in a different environment with different consumers, a different level of maturity in the home furnishing market in the UK. Can they translate their knowledge and expertise that they've got with Bunnings over there? All million-dollar questions. I don't have the answer to it. Clearly they've looked at the numbers, though, and they think that on the principles it stacks up. So I wouldn't bet against it, but there's a fair few question marks that need to be answered, and they won't be answered for another 2 or 3 years, I don't think.
Your thoughts as well, because Noel, there are some exclusions even inside the sale. Things like Habitat, which is actually quite a success story in the UK. They're not going to be included in this one in it. Are you disappointed that some of maybe the crown jewels will not be leaving and coming over this way?
No, what I'm really disappointed in, and Chris hit the nail right on the head, is I'm disappointed they're not in a different market, a growing one, one closer, one that we know better. I mean, here we see NAB trying to get out of the UK after, what, 15 years of being stuck in it. The UK is the single worst place that Australian companies ever go to, and why the hell they ever go there I don't know. It's a tough market, it's a competitive market, and it's one they think just because we speak the same language we know. That's actually 30. When you go to our own region, actually, you know what? You have to make a greater effort to understand the culture, and you have to adapt your business model. And that's what we do. I've never seen it, and I really would much prefer that they were expanding to Malaysia or to China or to the Philippines or crikey knows wherever else, or even to India. I'd much prefer to have seen that.
It's those gentlemen's clubs, though, isn't it? They're so magnetic for the board members. Surely that's going to be a large draw. They go back to London. It's like a pilgrimage, isn't it? Annual membership.
And if that's part of the strategic plan, get me out of there, because that's not why I'm buying the company. So you can have a cigar and a port.
And that's not based on anything other than a kind of a nice old world view.
You go tell that to a retiree living in Perth that's why you own the company, and I think you might have a very interesting conversation.
Noel, while we've got you, might move on from Wesfarmers just briefly from that story, because I've noticed a couple of upgrades coming in today from BHP from a couple of different brokers. Your view on whether we're nearing the bottom, and I know it's a tough one to call, but clearly a couple are calling it. Morgan Stanley and Citi both upgrading it to a buy. So
and Citi now as well, just a buy.
That's what it is.
Look, I had a bit of a chitter-chatter around with a few people yesterday. There's a general view from what I can pick up that the singular worst case that you might see for BHP is 12.50. So if we're looking here at what, 14.70, I think this morning, 14.50, somewhere in that range. So we're $2 off. The best case, if BHP, when it turns around, is not $18, it's probably 21, 22. So what you're seeing here is we're in the lower range compared to what the upside is when it turns around. The big question mark about BHP is the when, and that catalyst will probably come from some quantification out of the Brazil issue. Once they've got some quantification out of that, I think you'll find brokers generally will start to revisit BHP. Look, it's a cracker company. It's just got, you know, everything going wrong for it. Somewhere in this point, this is not a sustainable price for BHP. It's worth something more. What that is somewhat higher. So I think you'll start to see more and more broker upgrades for BHP as people start to call a bottom in this company.
Chris Conway, at the same time alongside it, in fairness, Fortescue gets a sell slapped on it and a price target cut to $1. Do you see this now as perhaps an opportunity? We were talking about China. They make the play to guarantee supply for generations.
For Fortescue?
Yeah.
Quite possibly, but they've been trying to do a deal with China for quite some time now. BHP and Rio have a lot of their production already sold into China, so yeah, it would be great if they could do it. I think $1 as a price target on FMG is a little bit too aggressive considering the amount of debt that they've paid down. They have been working very hard to tidy that up. So, look, it's aggressive. I won't say that it can't get there. I don't think that it will. Just to reinforce what Noel was just talking about, we actually bought BHP for our trading clients yesterday. Obviously, it's getting beaten up a little bit this morning, but as Noel was talking about, the risk-reward ratio is probably worthwhile in the sense that there's not too much more downside as far as we think, but the potential upside is worth having a crack at.
Yeah.
All right, there you have it. Chris Conway, we might leave it there with you. Thank you very much for joining us in the studio today. Noel Yates, always appreciate your company as well. Thank you very much.
Thanks, guys. Nice to see you.
Thanks, Noel.